So let's take a look at a little more complicated flow. This particular strategy is an example of a statistical arbitrage strategy, which is very popular among quant hedge funds. The idea here is that we buy two tickers at a time that are similar, short one, go long with the other, with the idea that we're eliminating bias that's associated with a particular ticker. It's not designed to give you big returns, but it's designed to give you very, very steady returns and market neutral returns. So regardless of whether the market's going up or down, you get a small percentage gain. The way when you end up looking at when you download these shared strategies, which you will be able to do once you learn your way around, you'll see that our machine traders have documented these flows up here. So these nodes are all documentation flows when you see these blue nodes. So you can click here and view the documentation that was written by our chief investment officer, Jerzy Pawlowski, who worked for many years as a quant on Wall Street. And he explains how the portfolio, how pairs trading portfolios work. And then the flow itself, this is set up so that at 9:30 every morning when the market opens, this flow will run. I'm not going to be able to demonstrate it now because the market is closed, but when you click, you could either click this or which would activate it right now, or at 9:30 in the morning on trading days, Monday through Friday, this will kick off. And this initializes and activates the strategy. There's a lot of detail that's contained in here. This is really the hard work of building algorithmic trading. So there's a lot of definitions involved. There's some explanations here when you see green type, that's documentation. But then this flow here is designed so that every 10 seconds during the trading day, it will execute. And it does all these calculates various things like a z-score, so it knows when to buy, when to sell. All these calculations are being done in here. There's two major styles of this, Bollinger, Ratchet. Ratchet limits the size of the positions that are accumulating. Bollinger allows the positions to accumulate a little larger. So you can test these out and see which ones work better. The orders are submitted then here. There's a little sleep node that allows us, that was written so that it waits to make sure that Alpaca has executed the trade before proceeding. And then in the flow here below, this is where the trades are actually sent to Alpaca, confirmed. We get back an ID, and then store that. And most of this information is being, I'm going to confirm any changes here. If we look at our sidebar, one of the sidebar utilities is called the context node, context data, and this shows what values we've stored. And in fact, as this is running, various flow variables are being created and stored that track the performance of this algorithm. So this is what a more complex trading algorithm looks like. Again, it can be intimidating at first, but it's a lot less intimidating than writing Python code. So let's turn now to actually looking at a little more detail on how each of these nodes work. Let me take a moment to remind you that at Machine Trader, we're not financial advisors. The content in this course and on our platform and website are for educational purposes only. To make the best financial decisions that suit your own needs, you must conduct your own research and seek the advice of a licensed financial advisor if necessary. Note that all investments involve some form of risk, and there's no guarantee that you'll be successful in saving, or investing money, nor is there any guarantee that you won't experience any loss when investing. Always remember to make smart decisions and do your own research. and test those algorithms carefully.